Welcome to this week's quick tip. I'm Dawn Clevisall. I am the person who started the group that you're most likely watching this in, which is Profit First for Business Owners. And I'm helping your business become permanently profitable. There's so much that goes into running your own business. I'm sure you know that from running your own business. However, there's a lot like on the accounting side that gets really confusing. And some of the things that I'm finding as people are implementing their cash flow strategies, we're really getting cash flow and accounting kind of jumbled together. So today I just wanted to come in with our quick tip and talk to you about how do you account for sales tax and tips, how is that affecting your cash flow? So I'm going to start with how is sales tax recorded in your accounting system? Because when we're talking about cash flow, we're really talking about the cash that's available for you to run your business. But when we collect sales tax from our clients, what we're doing is we are collecting money on behalf of the government to pay back to them later. So you'll notice if you are doing your accounting for this correctly, you'll notice that you do not have sales tax on your profit and loss statement. That is not where this is supposed to be. And if it is, reach out to me. I can help you get that fixed, because that's not where it belongs. What you should be seeing on your profit and loss statement, and you should see the amount that you collected that was actually income. And then over on one of your other reports called your balance sheet report, that's where you're going to see that sales tax that you collected. And that is called your sales tax liability account. So that is the name of the account that you would see and that you're going to record to when you're doing your sales tax. Because, as you know, that money is not your money. That's money that you're going to have to pay out. We don't want to include that in our cash flow analysis, or because that's just not where it belongs. So that is money that, again, you're collecting that on behalf of the government. It needs to be paid back to them. So whenever you have a sale that contains sales tax, a portion of that sale is business income. The other portion is that sales tax liability, or money owed to someone else. And that's why it's called a liability account. It's money that, whether your business continues after today or not, you owe that money to that entity. In this case, it would be the government. So let's imagine for a second that you collected $100, and that $100 included $5 in sales tax. What that should look like on your accounting system is $95 in sales, and then $5 to the sales tax liability account. It's really important that you have the correct system set up for this inside of your accounting system to ensure that you're correctly recording this. You do not want to record the entire $100 as income, because you're going to be basing your cash flow analysis, you're going to be basing your taxes based on the amount that is in that gross amount column on your income statement. And if you're including that $5 that really belongs to the government, you're overstating your income, which you do not want to do. That's going to cause you to have to pay more money out for taxes than you really want to. So the sales tax collected should never be included when you're calculating your profit allocations either. Again, we're talking cash flow. We're really talking what money is available to your business to run the business. So that cash that you collected is not income. What I would recommend if you have sales tax as part of your business is that you do have a separate bank account just for sales tax collected. And that way you're not going to accidentally spend the government's money, because that's kind of the slippery slope we get into, right? The reason that we're paying attention to our cash flow in the first place is we want to stop spending money that isn't ours, and we need to know what money is available for us to spend. So it's going to be very similar with your tips as well. So how are tips recorded in your accounting system? So tips, that's money that you've collected for your employee. Somebody wants to pay them, whether it's in the restaurant industry or whether it is, you got your hair done, someone paid a tip to your employee. The tips are recorded in an account called tips payable. So again, this is a liability account because that money isn't your money. The money is owed to the employee for whom that tip was collected. So whenever you have a sale that includes a tip, that portion should not be counted as income. And that's why it's really important that you're not, if you have the system, and if you have a system where you have to collect sales tax, if you're not like just service-based like my business is, where I can just say, okay, if I made $100, it's $100 income. If you have something like this, it's really important that you understand how to record this in your accounting system so that you're not making mistakes that are costing you lots of money. So this should be recorded as tips payable. That's where that money that was collected for your employee should go. And again, that you shouldn't see that on your profit and loss statement. If you're seeing an account called sales tax payable or tips payable on your profit and loss statement, then something's gone wrong and you need to give me a call. Reach out to me and we'll get it fixed, because that's not where this belongs. Again, this is money you're collecting. It's a liability to the business, because whether or not you're in business tomorrow, if you collected tips on behalf of your employee, you owe them that money that you collected for them. So it's going to be recorded to that tips payable account. And then when you pay the tip out to that employee, you're going to use the tips payable account to offset the payment. So ideally, you should end up with zero in that account eventually, once you have collected and then paid out everything that was in the tips payable account. So let's take that same $100 that we had before. I'm going to say that we have an additional $5 of that were actually funds that were tipped to your employee. So what we're going to do, instead of recording $95 as sales and the $5 to the sales tax liability, we're going to record $90 to sales, $5 to the sales tax liability, and then that remaining $5 that was a tip to the employee will go into the tips payable account. The total income that you use when calculating your profit allocations would be $90 in this example. As with your sales tax collected, the tips collected should never be used to calculate your profit allocations. This is money that is not part of your cash flow. This cash is collected, but it is not income to you. And I also recommend, same as we did with the sales tax, I really recommend that you have an account set up to collect this money, or you can use the sales tax account if that makes sense to you. If you don't have a large number of tips, it doesn't really make sense to have an account just for tips. If it's very rare, you might want to just, it'd be fine to put those in the same account. You can easily check your accounting system to see, which portion belongs where. You just got to make sure that when you are recording the payments, like I said, back out to your employee, that when you're recording that you're recording that correctly inside of your bookkeeping. So that is the quick tip for today, is that your sales tax and your tips are not part of your cash flow. Do not include them in your cash flow analysis. Do not include them in anything like that. And if any of this was confusing or made you realize I don't have the right system set up to do this, please reach out to me with a private message or DM, and I would gladly get on a call with you and we'll figure it out. So thank you for joining me for today's quick tip. I hope you have a wonderful weekend.